All right, so this is probably the longest lecture for chapter 4 for the income statement. So we're going to kind of talk about comprehensive income very quickly, and then we're going to go into the comprehensive example. And so, sorry, every time. So there is this additional measure of income called comprehensive income. Most students are very familiar with net income, sort of the main measure of income that's used inside and outside of accounting. But there is also this other thing called comprehensive income, and so it really is a broader measure. It's a fuller measure of all the things that affect a broader measure of income. Basically this larger number of non-owner transactions. And so it's sort of, if you can imagine, sort of the majority of transactions and economic changes are captured in net income. And then there are these other things that are part of comprehensive income. And we're going to kind of walk through the difference between the two. It's more conceptual than anything else, but let's kind of walk through it. So what is the difference? Well, there are some gains and losses that are not part of net income. There are certain things that deal with foreign currency, pensions, and certain types of investments where there is a change in the value or a change in an estimate, but it's not realized, or it's not clear how it's going to be realized. And so its impact on income is sort of might be an impact, but is not yet an impact. And so it's this sort of, I would say, sort of nebulous sort of income related items where it's important as far as value relevance. It's important in at least some decision making, but it just hasn't risen to the level where it would be reported as part of net income because of lots of different things. Usually it's has not been realized. That's a big one, meaning that an actual transaction hasn't taken place. And then secondly is that its impact is not readily direct. So as an example, I may have assets or bank accounts in a foreign country, and it's still in that foreign country. And basic idea is, well, if I were to bring it over, here would be the impact on income compared to when I originally made the sale in that currency. Well, the reality is I only have experienced that impact if I bring the assets over into the US and try to get them dollarized. But if I never plan on doing that, then I haven't really had this negative impact. And so, that foreign currency, that potential foreign currency transaction is something that would fall under this category. And there are similar things with certain investments where, well, if you were to sell it, this is what would be your gain or loss, but you really haven't said whether you're going to sell it. And so we don't know whether it's really going to be a gain or a loss. And so, these types of things, because of their sort of nebulous impact on income, and the fact there has been no real transaction yet, is why it gets into this additional category called other comprehensive income. And so, again, we're not going to go into a lot of detail in terms of on the test, but I just want you to be aware of this measure. And so basically what you have is you have net income, which is the core, normal income items. And then you do have these other comprehensive income items. And then together, they give us comprehensive income. And so other comprehensive income items can be gains or losses, just like net income could be a profit or a loss. And so it's similar in that regard, but together, that's where we get our measure of comprehensive income. So how do these things map into the balance sheet? Again, net income accounts, when they're closed, these temporary accounts are closed retained earnings. Other comprehensive income accounts map into, if you remember from the balance sheet chapter, we had that accumulated other comprehensive income account, and that's really where they flow into. And so, it's a permanent account. Each one of these unrealized accounts is not really closed. It sort of sits in both places. So it's part of comprehensive income. The change is reported as other comprehensive income, but the accumulated change is accumulated other comprehensive income, which is a balance sheet item. So it's similar in that they both kind of map in between the two, a little bit different in that the actual underlying account isn't really closed. All right, so now let's kind of walk through a comprehensive example. So on a test, you're going to be given these accounts or accounts like these, plus others. On the test, just like the previous balance sheet test, I included both balance sheet and income statement items. On this test, I'm going to do the same thing. But you can see here is a list of only income statement related items. And so we're going to go from sales revenue all the way down to net income, knowing that sort of there's 3 sections that you're going to need to present. You're going to need to present, continued operations, discontinued operations, and then also earnings per share. So we're going to kind of walk through that here. And there's more detail if you're in your lecture guide. If you don't have me for class, maybe you can reach out to somebody who does and get the underlying information. But most of it's going to be here. You're going to be able to navigate it. All right. So notice at the top right away, you have the name of the company, the name of the statement, and then notice the format of the date. Again, the idea is that an income statement accumulates economic activity over a period of time, and so we want to note that in the way that we format in the way that we format the statement. So for the period ending, you could be for the year ending, but I'm fine if you just say for the period ending 12/31/2022. And then, of course, we just kind of work our way down. And at the very top, we start with our sales revenue and cost of goods sold. So we have our primary revenue account, and then usually our largest expense, which is cost of goods sold. And we know the difference between those two, as we talked about last time or a few times ago. That is gross profit. And again, a lot of times, especially with small, medium-sized businesses and even larger ones, when someone talks about, oh, my margins they kind of talk about their margins. Well, when you talk about your margins, this really is the number that you're trying to get at. What is my profit after covering my cost of goods sold? And so, in this case, obviously it's above 50%. If you wanted to calculate it more directly, of course you could do that, but that's the margins. And so we talk about gross profit. That's sort of that first stopping point. It's sort of it's an important measure, especially with any inventory-based company. With service companies, gross profit's probably not as critical. But with anything that's inventory-based, gross profit is a very important measure. And then we start listing our operating expenses. And again, you sort of can keep going back to that sheet that references all the different ones. What I would suggest you do is hit pause here, go back to the sheet before and see if you can identify all the different operating expenses. We're going to kind of walk through them sort of all at once, but I'd pause here and see if you can pick out all the different operating expenses. And so here is the list. I kind of didn't really list them in any particular order. Admittedly, they're usually not in any particular order. And so looking at it, you can see, salaries expense, advertising expense, supplies expense, rent expense, insurance expense, and depreciation expense. And again, I want to be clear, when we talk about salaries, supplies, rent, insurance, and depreciation, the reality is these types of expenses are typically also included in our cost of goods sold, usually as part of manufacturing overhead. So if you've had a cost accounting class, you probably heard, there's kind of 3 components to cost of goods sold. There's direct labor, direct material, and manufacturing overhead. Well, that manufacturing overhead piece includes a lot of indirect costs, which could be salaried employees, it could be shop supplies, it could be rent of a facility, it could be insurance, and it could be depreciation of assets used in that facility. And so I want you to understand that sort of included in cost of goods sold are these types of expenses as well. And so it does get a little bit complicated as far as your accounting system, because a lot of times what you might do is you might designate certain salaries as being included in cost of goods sold and other salaries as part of your salaries expense. So like the CEO probably be separately reported as a salaries expense, whereas if it's a foreman in the factory, it's probably going to be included in cost of goods sold. And so just understand that it can get complicated in practice. Now, for our class, it's going to be very, very straightforward. Cost of goods sold, when it's given, captures everything that should be included in cost of goods sold. Salaries expense are those items that are meant to be separately reported under the operating expense section. So for this class, I'm not asking you to try to figure that out. What I am saying, though, is I want you to understand what cost of goods sold really does capture. And that does capture some of these same types of costs. It's just going to be reported as part of cost of goods sold because it's part of your inventory cost. So all that to say, when you do have these expenses, notice that we're now using the middle column, right? So we indent because we're going to be subtotaling. So similar to the way we did on the balance sheet. If you're subtotaling something, it moves to the middle column, and then the total gets reported out to the right. So when I sum all these up, I get 47,000. So that's my total operating expenses. And so then the difference then between gross profit and my operating expenses. Oh, also notice that these aren't negative signs or anything like that, because everything in here is an expense. There's no reason to make them negative. It's known, just like up here with cost of goods sold. We don't make it negative. It's known that it is an expense. And so that's why we handle it this way. So if you on a test or something, if you were to put a negative sign in front of any of these, you would lose a point for doing that. So this is the right way to report it. Don't report it any other way. I'm not saying no one has ever put a negative sign, but what I am saying is that is really not the way it should be done. All right, so the difference between those two is income from operations. And then below that are the other items, so other income and losses. Now, the difference in this section compared to operating expenses is that you can have both income items and loss items in here. And so in this section, you will distinguish expenses as negative and gains and revenues as positive. So expenses and losses are negatives and gains and revenues are positives. And so that is a little bit different, because in this section, it can be either one. And so we need to make sure that we identify which direction it goes. And so in this case, there were two other items, interest expense and the gain on sale. Notice the interest expense is designated as a negative, and the gain on sale is a positive. Notice the way that this is reported: total other income, and then I say parentheses loss. What that means is, and I similarly did it up here, if you kind of see it up here. What that means is losses or expenses are going to have parentheses around them, and then gains or revenues are not. And so in this case, in total, we had a gain, we had positive income. So notice there's no parentheses. If in total this had been a loss, then there'd be parentheses around this number. And so again, I'm just trying to, I want you to understand this section is a little bit different than the operating expense, because you can have both expense and losses in addition to revenues and gains. And so it's just a different situation. Now, because of my space here, I do need to kind of go left to right, but what I'm going to do is I'm going to kind of bring the rest of this, understand it would be underneath. So normally this would just kind of continue north-south. So when you take a test, this is just a continuation. I wanted you to be able to see it all at once, but obviously when my my presentation is oriented more, you know, what is that, landscape, but your test is portrait, you're going to make sure you keep going north-south. And so after our total other income and loss, the next section is our taxes. And I'm guessing that that might be hard to see. So I'm going to move my thing over here. I don't know if that's going to work. We'll see. But now your income before income taxes is 34,550, which is 32,300 plus the income from my other items. So that gets us to 34,550. And then we calculate our income tax expense. It's given as 30%. At least I think that was the percentage in the problem. I don't have it in front of me, but that looks about like it's 30%. So anyways, looking at that, you can see then we subtract out the income tax expense. Again, this is all still continuing operations. And then that final total then is our income from continuing operations. And so, you know, our income before income taxes minus our income tax expense gives us our income from continuing operations. And of course, really what we're left with then is kind of three measures of income within continuing operations. We have our gross profit, we have our operating income, and then we have our income before taxes, and then finally our income from continuing operations as the sum of all those pieces, or the net of all those pieces. All right, so then the next section is discontinued operations. And so within discontinued operations, I'd mentioned there's several ways to present this. In this case, what I've given you in the problem is I gave you the loss, and then of course, then you apply the tax rate. Now, because it's a loss, you do have an income tax benefit from that loss. So notice that in this case, because there was a loss up here, then the income tax calculation ends up being a benefit. If this had been a gain, then there would be an income tax expense. And so it's sort of whichever way you go. If it's a loss, it's a benefit. If it's a gain, then it's an expense, because the reality is gains result in more income tax expense, whereas losses result in less income tax expense. And so But similarly, we take that loss, we multiply it by 30%, and that calculates our income tax benefit. And then the net is what's reported in the right column. So notice, because we're subtotaling this, we report the net over here at the right. So we have this loss plus the benefit gives us a net loss of 1,246. We combine that with our income from continuing operations, and now we have our net income, $22,939. All right, so that's that bottom line net income, which consists of income from continuing operations of 24,185 and loss on discontinued operations of 1,246 net of tax. All right, so then the final section, earnings per share. And again, we're going to be very basic, but we do want to present it properly. And there are three measures of earnings per share, as we previously discussed, that we need to include. And so those three measures are income from continuing operations, discontinued operations, and net income. As a reminder, continuing operations includes any preferred stock dividends. Discontinued operations does not. And then net income also includes preferred stock dividends. Again, because these two are connected, so it's sort of important to note that. And then we have to calculate, or we'll be given our weighted average common shares outstanding. So that's the other piece that we need. So let's kind of walk through that first. So our weighted average common shares outstanding is $7,800. And again, I don't have it in front of me. I wish I should have pulled it up. Maybe I can try to pull it up over here. See what that's going to do. All right, let me take a look here, see what I gave you. So I apologize for the delay, but it will be worth it. Trying to remember what I gave y'all. There we go. All right, so looking at this, what did I give you? All right, okay, so I just gave it to you straight up. All right, so 7,800 shares. So that's the nice thing. So it makes it easy. So I gave you the weighted average common shares outstanding. You do need to report that, because obviously that allows you to allows a user to see where you got your earnings per share numbers. And so all right, so we're going to kind of bounce back over here. All right, so our income from continuing operations is just our amount, 24,185 divided by 7,800. That's where that $3.10 came from. And then our discontinued operations is our 1,246 divided by 7,800. Again, I don't think there were any preferred stock dividends in this case. I probably should have looked. Oops, that's not what I wanted to do. Yeah, no preferred stock dividends, so that made it easy. Again, and then finally, our net income is 22,000. Oops. Let me go back here. Sorry. Is 22,939 divided by 7,800 gives us our $2.94. And again, really, it should be the sum of these two as well, because obviously they sum up to get us net income. All right, so next section is statement of cash flows, and I think we're going to go ahead and include it right here, just to kind of make it a little more efficient. And then we'll do ratios on a different one. So we talk about our cash flows. Really, the first step is to classify them, and we already talked about this a little bit, so this is somewhat of a repeat. But again, there were three major types of cash flows: operating, which are day-to-day activities, including interest payments, and then investing, buying and selling long-term assets. Then finally, financing, which are cash flows that deal with our capital resources, whether it's investors or creditors. The only thing that's not included in that is interest payments. So for whatever reason, interest payments are included as an operating cash flow, not as a financing cash flow. So just make note of that. All right, so let's talk a little more about operating cash flows. So they're really tied very closely to the income statement, because both of them really do focus on the underlying operations of the company. There are some exceptions, but they really are tied together. And so, but we also know that the income statement uses accrual-based accounting, whereas obviously here we're after the underlying cash flow. And so in addition to that, the income statement does include some types of investing activities, like if you sell a piece of equipment, or even some financing activities if you were to have something like a loss on a bond retirement. So it's not exactly corresponding, but the majority of the activity is a nice map in between the two. So with those two caveats, it does kind of create a little bit of a disconnect between what net income is and what you might report as your operating cash flow. And so what are some examples of operating cash flows? And these are just a list of 6. So you have receipts from customers, payments for interest, payments to suppliers, payments for rent, payment to employees, payments for insurance. There's these kinds of cash flows. These are the day-to-day ongoing activities that you have. And so, and again, we're not going to prepare one in this chapter. We just need to understand how there's a difference between what we see as net income and what we might see as an operating cash flow. And so, what is the difference? So let's kind of think about sales revenue as a specific example. And the only reason why I'm using it is because it's one we've used before. It's sort of an ongoing example. And so, when you talk about what you get from your customers and what you record as revenue, we know that they should be very close and very similar, but in any given period, they're really not the same thing. And so we need to understand, how do we reconcile those two? So how do we connect the statement of cash flows to the income statement and the balance sheet? And so again, sales revenue is an economic transaction that means we've completed the sale. That economic transaction is sometimes at the same time as the cash flow, but a lot of times it's not. So the cash flow could be influenced by the collection policy, and it could be collections from prior periods. There could be prepayments on deferred revenues as well, that you haven't recognized as revenue. So there's a lot going on in addition to just the cash flow. And so when we think about going from a cash flow to an accrual-based measure or vice versa, we really do need to understand that there's what's reported on the income statement as sales revenue, and then there are the balance sheet items, the receivables and the unearned revenue or deferred revenue, and then there's the operating cash flow, and those are the receipt from the customer, and all those are kind of connected together. All right, let's continue here. Oh, sorry. All right, so what are the 2 methods for preparing the operating cash flows section? All right, the direct method. With the direct method, you list every single item separately. Receipt from customer, payment to supplier, payment to interest, it's all listed. With the indirect method, it's more of like an aggregate approach where you have net income and then you kind of make adjustments to net income based on accruals and those other things in order to get to the actual cash flow. And so it's more of an indirect way of getting there. The bottom line is the same, no matter which method you use. The direct method says, here's the cash receipts from customers, here's the payments to suppliers, it kind of lists them. Whereas the indirect method says, well, hey, here's net income, and we're trying to get you to understand how I go from net income to the operating cash flow. And it just kind of walks you through that process. And so both are informative, just in different ways. Investing cash flows. Buying and selling long-term assets. So some examples of that is, cash purchases of land, building equipment, other long-term assets, or cash sales from the same items. And then again, back to our question before, is how does a cash flow connect to the income statement and balance sheet? And in this case, it's a little more complicated. So we talked about with sales revenue, you have the sales revenue number, you have the cash receipt, and then the balance sheet items, receivables and unearned revenue, connect them. And we could similarly do that with other items. If you have interest expense, you'd go from the interest that you pay, and the interest expense would be kind of reconciled by interest payable. Kind of a similar idea. Here, it's a little bit more complicated in that, let's talk about land as an example. So whenever you sell the land is going to come off the balance sheet at whatever its cost was, but you may have a gain or a loss that's reported on the income statement. And then together, you would be able to kind of marry those up. So if I had a cost of land that I sold of $500 and I had a $100 gain on sale, I know then the cash flow from the sale must have been $600. And that's sort of how you work through reconciling what's reported on the income statement, what you see on the balance sheet, and what you would see on a statement of cash flows. So again, this chapter, we're not asking you to make those connections very strongly, but in the future, you will be able to map. You're going to need to be able to map that in your head. All right, financing cash flows. Again, these are flows between capital sources and the company, investors and creditors. Some examples: cash from issuing stocks and bonds, payments of dividends, payments for repurchasing stock, and retiring debt. So let's talk about the cash retirement of a bond. How would that be reflected on the balance sheet? And again, you probably haven't seen this yet, but whenever you retire a bond, your bond payable, goes down. So we're going to reduce the bond payable account. But depending on when you retire that bond, you could have a gain or a loss, and that would be reported on the income statement. That is not for this chapter. That is for a later chapter. But again, you get another idea of how there may be a difference between what you see on the balance sheet and how you can use the balance sheet and the income statement to infer the cash flow. Dividends are a little more complicated, and that dividends aren't on the income statement. They're on the statement of shareholders' equity. But what you report is based on what's declared, not what's paid. And so if there's a dividend payable, all of a sudden now you're going from statement of shareholders' equity, and lots of things going on that you're trying to now go from that statement through the dividend payable to get what you actually paid in that period. And if you don't have the dividend amount from the statement of shareholders' equity, then it gets even more complicated. And then you have to go to retained earnings and net income and sort of bring all that together. But again, that's really left for a different day, a different class. All we're trying to do here is highlight the fact that when you're talking about cash flows compared to accrual-based accounting on the income statement, or whatever you report on the balance sheet, like those three things, you've got to, at some point in your education, start making those connections. And again, in class, obviously, there's going to be a lot more questions. We're going to be able to hash through this a lot more, but here we're just trying to hit the highlights. So hopefully that's helpful. That's all for this one, and then we'll finish up with profitability next time.